Will Rogers said, on Wall Street, there are more commissions paid out to stock salesmen than profit is collected by stock buyers. There are more than 675,000 financial advisors in the United States today. We can estimate that there maybe are 4,000 or 5,000 who actually know what they're doing and place your interests first. That's far too great a percentage of the rest left as salespeople trying to sell you something. One of our favorite people, Warren Buffett of Berkshire Hathaway, calls them helpers. They come in a variety of shapes and sizes, accompanied with designations. A few of them actually mean something. Under the guise of investment advice, they give you a simple questionnaire and try to fit you into a model, say a 1 for very conservative and a 6 for the most aggressive. Individual investment objectives do not fit into that matrix. Let's look at the different types of helpers. The first place to look for a helper is your bank. Some banks employ branch or regional investment salespeople that are generally salaried and undertrained. They may know a little about mutual funds. Then there are insurance agents. They can be licensed mutual fund salespersons, and they usually like annuities a lot. Go to an insurance agent for your investment advice? I ask you this, would you go to Jethro the barber to buy life, home, or auto insurance? Okay, maybe some of you would, but I can't help those that are severely damaged. Insurance agents are accustomed to receiving huge fees for selling their products. Stockbrokers are trained to sell stocks and bonds and a plethora of other products which the firm makes big bucks from. Stockbrokers may get commissions on trades, but if you pay commissions, you're probably overpaying. Brokers may also get asset-based fees, but be careful. Fees in lieu of trading are seldom cost-efficient unless a lot of trading is done. CPAs are perhaps your most important advisors. Use them for tax, estate, and audit advice, at which they're very good. They're highly trained professionals and have a strict code of ethics to follow, which usually mandates the avoidance of rendering investment advice for a fee, because there are inherent conflicts. Pay them well for the expertise they provide, but don't expect them to tell you exactly what to do with your money. How about lawyers? Get serious. The only people worse at managing their own money than lawyers are doctors. As a lawyer, I can personally attest to this fact. Whatever you pay my lawyer colleagues, it's probably too much. Don't pay them for investment advice. Well, financial planners. They don't like that term anymore, and they hide under a variety of cloaks like investment advisor, financial consultant, investment consultant, or some other generic euphemism. You may pay them for a financial plan and then turn around and pay them fees for implementing it, like 12B1 fees. We'll talk about that later. Some of them tout fee-only service, but I wouldn't pay them asset-based fees. I think it'll rip you off. Think cash. Financial advisors represent a large growing population of variously trained and variously motivated salespeople. Their fees, like their training and motivation, are all over the board, and it's difficult to separate the good from the not so good. Think of it this way. Somewhere in the country, there is the world's worst financial advisor. The bad news is that somebody has an appointment with them tomorrow. Registered investment advisor requires no specific qualifications and no standardized testing. Registration with the Securities and Exchange Commission costs about $175 and means nothing. Don't get too excited about this designation. They're Series 7 licensed people who filled out long federal forms, just another financial advisor. Investment consultant is another overused term, but the very good are well trained and they don't charge you 1% of the assets for their services. Some of them have designations. There are hundreds of organizations which exist to charge helpers big fees to put them through a course, usually home study with an open book exam, and then give them a fancy certificate to hang on the wall and letters to put on business cards. There are a very few that actually signify investment expertise. Most do not. Let's look at some. CFP, Certified Financial Planner. Good for very general advice. Good for a plan that's written and it talks about taxes and estate and some other things, but there's no depth to it. Then there's CHFC, Chartered Financial Consultant. I have no idea what that means. Then there's Certified, or some other official sounding term, Financial Advisor. Probably costs less than the CFP, and there's a reason for that. Fourth, any designation with a U in it has nothing to do with investment advice. Keep that in mind. Then there's the term fiduciary advisor. It's a child of the Pension Protection Act of 2006 that empowered thousands of underqualified persons to give some sort of advice to people about to retire. And the term senior advisor. Now, it's not an old advisor, but one supposedly specializing in advice for seniors. Are you going to trust a 31-year-old with a certificate on the wall with that power? One designation to keep in mind is CIMA, C-I-M-A, Certified Investment Management Analyst. It's a difficult, demanding program taught at leading universities, and it requires rigid analytical study. It's offered by the Investment Management Consultants Association, which imposes a strict code of ethics on its members. The bad news is there are only maybe 4,000 or 5,000 CIMAs in the country for this reason. It is a symbol of qualifications in the investment industry. But the best designation is CFA, Chartered Financial Analyst. It requires a rigorous 3-year course of study, which only the smartest analytical minds can endure. It is the best finance credential. But there are plenty to be wary about. For instance, elderly clients thought they had every reason to trust Michael Delmonico as a financial counselor. After all, the Massachusetts insurance agent had become a certified senior advisor in 2002, a credential he made sure to advertise on flyers he sent to retirees. He didn't mention how easy it had been to get that title. He paid $1,095 for a correspondence course and then took a multiple-choice exam with questions like, marketing can best be described as... The answer is the process or technique of promoting the sale or distribution of a product or service. Like more than 18,700 applicants, he passed. Insurance companies eager for sales representatives embraced Mr. Delmonico, as they have thousands of other newly credentialed advisors. The following year, insurers had commissions worth $720,000 as his business with retirees soared. But many of those sales came from steering older Americans into unwise investments. Massachusetts regulators took a look. Mr. Delmonico denied all wrongdoing, but one of his clients, a 73-year-old widow caring for a son with Down syndrome, says he tricked her into buying complicated insurance contracts that left her unable to pay dental and home repair bills. His office was filled with things saying he was certified to help seniors, said that client, Mary Ann St. Clair. The only ones he really helped was himself. Mr. Delmonico is one of tens of thousands of financial advisors working hand-in-hand with insurance companies to market themselves to older Americans using impressive-sounding credentials like Certified Elder Planning Specialist, Registered Financial Gerontologist, Certified Retirement Financial Advisor, and Certified Senior Advisor. Many of these titles can be earned in a few days from for-profit businesses and sound similar to established credentials like Certified Financial Planner that require years of study, difficult tests, and extensive background checks. But the degree isn't worth the paper it's written on. It's a scam. It's a way to put a title on a business card that impresses gullible seniors. Many graduates of these short programs say they only want to help older Americans, but they're frequently dispensing financial counsel that they're unqualified to offer. Thousands of them are paid by some of the country's largest insurance companies like Alliance Life, Old Mutual Financial Network, and American Equity Investment Insurance, or Life Insurance. And their job is to sell elderly clients complicated investments that economists say most retirees should never own. The prize for these companies and these self-designated advisors is a piece of the $15 trillion held by Americans 65 and over, the largest pool of assets ever amassed by an aging population, according to the Government Accountability Office. As older Americans' wealth has grown, so too have programs that quickly offer credentials or that teach agents how to sell to the elderly. The number of certified senior advisors has increased by 78% in the last 5 years. There's more than 24 such programs now existing, and they've enrolled more than 39,000 people. As more baby boomers retire, the number of programs and enrollees is likely to grow significantly. Some of the existing programs, which are often linked to insurance companies, have taught agents to use abusive sales practices, according to the regulators. Over 1/3 of all cases of financial exploitation of the elderly involve annuities. according to the North American Securities Administrators Association, the group of regulators that controls investment regulations in 49 of the 50 states. Hundreds of lawsuits have been filed against insurers over annuity sales to the elderly. A judge in Minnesota ruled last year that just one class action suit against Alliance would encompass as many as 400,000 plaintiffs. There are hundreds of programs, one's called Piece of Pie, that teach sales agents how to find retirees willing to buy annuities. Most of them are paid by insurance companies. Piece of Pie was founded by Michael Kazelnak, who was fined by the regulators in 2001 for selling improper financial products. Many elderly buyers of annuities agree and say they've been treated as callously by their insurance companies as they were by deceptive sales agents. And last year, Massachusetts prohibited most financial advisors from using titles like Certified Senior Advisor unless they were recognized by an accredited organization of the state.